Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at a top dividend paying company from every sector in the market. The overall S&P 500 can be broken down into 11 different sectors. And in this episode, we're going to take a look at a top dividend paying company from with each. In no ways it's the best company from each sector, but it's a strong dividend paying name to take a look at for your own portfolio. And as a blue chip dividend investor myself, I own a lot of these companies in my own financial freedom portfolio that is now worth around $104,000. And as we saw a market pullback at the end of the week, I did lose around $1,400 in market value in one single trading session. But overall, as a blue chip investor, I buy strong dividend paying companies with the goal to own them over the long term and collect my growing passive income every single quarter. And in this video, we're going to take a quick look at 11 different companies, one from each sector, that provide some nice income to their shareholders quarter after quarter and are expected to do so for long into the future. So before we jump into that first sector in that first company, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And how we're going to do this is go sector by sector, starting with the largest sector in terms of market cap within the S&P 500, which is information technology or the tech sector. And the dividend company I've included in this video from the tech industry is ticker MSFT, which is Microsoft, the second largest company in the world, currently trading for $259 per share, and they've grown by 34% on the 1-year chart. Of course, they're just behind Apple as the second largest company in the S&P 500, and they have a current market cap at $1.94 trillion and a current dividend yield at 0.86%. And this company is an absolute beast. Year after year, total revenue continues to grow to just under $196 billion of sales in the trailing 12 months. And taking a look at their bottom line, they are extremely profitable with over $56 billion of net income over the past year as well. And if we take a look at the dividend scorecard, the yield does start out very low at only 0.86%, but their payout ratio is very minimal as well, only coming in at 29% of their net income, and their 5-year dividend CAGR is right around 9.5%, and this is a company I predict will return a ton of capital to their investors through share buybacks and a growing dividend for decades to come. And currently, they have the highest dividend safety score possible, coming in at a 99 from Simply Safe Dividends, and this is the largest position in my personal portfolio as well. It makes up 16% of my total assets, and I'm up more than 36% on this position at this current point in time, and I own 64 shares of this market-leading tech company. So of course, I am having a little bit of bias because I do love this company very much. They are my number one position, but also in my portfolio, I am a big bull on Apple as well, and that is the second largest holding, making up around $13,000 of the total portfolio value. But within the tech sector, there are a ton of great names to take a look at. So Microsoft is the first company and the first dividend growth name included in this video. And now if we jump into the second sector, that is healthcare, which makes up just over 13% of the total S&P 500. And the company I've selected is ticker J&J, which is Johnson & Johnson, who currently trades for around $162 per share, and they're up by 14% on the 1-year chart. This is a healthcare beast. They have a current market cap at $433 billion. They're trading with what I believe a very reasonable forward PE ratio of only 17.29 and a nice dividend at over 2.5%. And Johnson & Johnson generates so much revenue year after year from a very diversified product mix. Currently, they have 28 different platforms and products that generate over $1 billion in sales. So this company is so strong and nicely diversified that even if one or two of their main products does go down in revenue, the company will not suffer. 28 different billion-dollar brands under the J&J umbrella is incredibly impressive. And if we take a look at their dividend scorecard, a yield of 2.5% makes up only 44% of their net income. Once again, very low, extremely sustainable. And their 5-year dividend CAGR comes in at 6%, and this is a dividend king with 58 consecutive years of dividend growth. And even after 50 straight years of dividend increases, they still maintain the highest dividend safety score possible, coming in with a 99, and very unlikely J&J cuts that dividend anytime soon. And something I want to share about the first two stocks we gone over in this video is that they're the only two companies to actually have a higher credit rating than the US government. Johnson & Johnson and Microsoft are the only two companies that are rated as AAA and have a higher credit rating than the entire US government, which is absolutely phenomenal. And I do own both of these companies in my own portfolio, and I feel very confident they will continue to deliver very strong results over the long term. And now if we jump into sector number 3, it's going to be the consumer discretionary companies. And the one I've chosen for this video is ticker HD, which is the Home Depot. They trade for $302 per share. They've grown by 20% over the trailing 12 months and have a market cap at $321 billion with a dividend yield at 2.18%. And over the longer term, this company has seen incredible performance, growing by 138% for just the capital appreciation over the past 5 years. And for the past decade, they're at more than 777%, which is absolutely remarkable. In taking a look at the income statement, they've seen incredible growth as of late. Every year, their revenue continues to increase, but from February 2020, we have seen some major expansion to over $141 billion of total sales in the trailing 12 months. As the economy shut down and more individuals were spending time at home, they wanted to improve their home because they were spending so much time indoors. So where do you go when you want to buy home improvement warehouse supplies? You go to Home Depot. So this company as of late has seen a major surge in revenue, and the trend of improving your home is expected to continue for the next few years going forward. And if we take a look at their dividend, the yield comes in at around 2.2%, payout ratio of 47% of their net income, but what's extremely impressive is their 5-year dividend CAGR sits at just below 20%. So this big retail giant continues to grow their dividend in the high double digits year after year. So although the current yield may be low in terms of a dividend company, it's compounding and accelerating at a very fast rate. And again, another very safe company coming in with an 87, so extremely unlikely we see a dividend cut coming anytime soon. So Home Depot was the third company we're going to go over in this episode, a representative of the consumer discretionary sector. And now if we move into sector number 4, we have communication. And of course, this company I don't think is a surprise to many investors, and I'm going with ticker VZ, which is Verizon, trading for right over $55 per share. The company's flat over the past 12 months, and they have a massive, nice high dividend yield at 4.44%, with a very low forward PE ratio of only 11.1, so a lot of value coming with this company at this current share price. And taking a look at that major dividend, around 4.5% is pretty unlikely in our current market environment. When every company is trading near all-time highs, it's getting harder and harder to find some nice, high-yielding, strong companies, and Verizon is one of the few on the market. Their payout ratio only makes up around 50% of their net income, so I do believe it's sustainable over the longer term, and the dividend does start out very high, but it's not growing at a very fast rate, and it only averages between 2 and 3% annual growth year after year. But if we take a look, the dividend is considered very safe, so we're not expecting a dividend cut coming anytime soon, and they do have a very strong dividend history, and we haven't seen a reduction over the past 30 years, which is a great sign. And now if we jump over into stock number 5, it's the company from the financial sector. And the bank I chose to represent this industry is ticker JPM. JP Morgan Chase, the largest bank in terms of assets and market cap, comes in for around $148 per share and is up 52% over the past year. Throughout the 2020 pandemic, the banks got absolutely destroyed, losing anywhere from 40 to 60% of their market valuation. People thought all loans were getting deferred, people were expecting major credit losses, but that really didn't happen. The banks were extra conservative, they were playing it safe, and really, nothing too bad happened to these companies. And we can see they've rallied dramatically from the March lows and continue to perform very well. But over the past few weeks, as we've seen some talks about inflation and some different issues on the market, JPM has fallen over 11% over the past few trading sessions. So now might be an excellent opportunity to buy the dip on the market leading bank at a cheaper price than where it was just a few trading days ago. And we can see right now they offer a yield at around 2.37% with a forward PE ratio of only 11.6. And we can see that throughout the 2020 pandemic, the company did see a decline in revenue. But if we take a look from that low point in March 2020, we can see at the top, their quarterly revenue has absolutely exploded back to the pre-pandemic levels. We can see over the past 5 quarters, $20 billion of revenue, a major decline. Then up to 22, 28, 31, and now $36 billion of total revenue in the quarter ending March 2021. So in the same quarter a year ago, they generated $20 billion. Now fast forward to 2021, we've seen a major recovery to over $36.4 billion of total revenue, which is absolutely insane. And along with this massive growth, the company has announced major share buybacks for this year, and they actually plan to buy around 5% of their outstanding float, which would be absolutely incredible and would be returning a ton of capital to their long-term investors. And we can see right now the yield comes in at 2.37%. The payout ratio is extremely low at only 28% of their net income, and their 5-year dividend CAGR, even though they haven't raised their dividend over the past 4 quarters because of the Fed's restrictions, still sits at 15% per year. And I do believe once they are allowed to raise that dividend, we will see a nice hike to this annual payment. And if we jump over to Simply Safe Dividends, they still have the company considered as borderline safe. I personally don't believe that's the case. I think the banks are in a very strong position. I think the fact that they're doing major share buybacks means they have a strong balance sheet and they can afford to actually raise the dividend once the restrictions are lifted. So right now, I think this borderline safe rating is very conservative and the overall health of the banks is much stronger than this 60 rating. So this was the company number 5, the representative of the financial sector. And the next sector we're going to go over is industrials, which makes up around 8.4% of the S&P 500. And I have chosen ticker UNP, which is Union Pacific. They trade for $215 per share and are up by around 28% on the 1-year chart. And I think railroads are going to be very strong for long into the future. The government is not building new railroad infrastructure, and the existing companies will dominate for decades to come. Going forward, there's still a lot of products that need to be shipped by rail. And if the government's not expanding these networks, the railroad systems in place already and the existing companies will continue to generate growing revenue and cash flow, I believe, for decades in the future. And we can see UNP comes in at a market cap at $147 billion, a forward PE ratio of 22.8, and a dividend yield just below 2%. And right now, their payout ratio is sustainable, making up only 44% of their net income. They have a nice 5-year dividend CAGR at over 12%, and currently, the dividend is considered very safe, coming in with an 88, and the company has not reduced their dividend over the past 22 years, which is a great sign. So overall, UNP, a strong railroad company that I believe will have consistent cash flow for long into the future, is a strong representative of the industrial sector. And now moving on, sector number 7 is the consumer staples. This is a major player in my personal portfolio. I am a big bull on consumer staples. I think during times of volatility in the market, it's nice to own these strong blue chip brands in your portfolio, and I personally allocate around 12% of my overall weighting in my portfolio to consumer staple companies, which is pretty much double the S&P 500's value. And the company I've chosen for this video is ticker PG, which is Procter & Gamble. They trade for $132 per share, up only 13% on the 1-year chart, and they have a nice dividend yield at 2.6%. This company operates and sells products in 10 different consumer sectors, and everything they provide is a necessity. So no matter what's going on in the economy, through good or bad times, consumers continue to have a demand for Procter & Gamble products, and revenue continues to flow into this business. And they've been one of the strongest dividend-paying companies throughout history. They've been paying a dividend for 131 years and have raised it for 65 consecutive years. So a dividend king, a 65-year dividend growth streak, and even after such a long dividend history, their recent increase was by 10%. So the company has still proven they can have some major dividend growth even after such a long period of overall operations. And we can see as the company continues to grow, they return more and more capital to their investors as time goes on. Back in 2019, they only returned around $13.5 billion in the terms of dividends and share buybacks. Fast forward 2 years later, that's going to grow to $19 billion returned to their shareholders in only a 2-year difference. So overall, $11 billion of share buybacks, $8 billion of dividends, and over the past decade, they've returned a total of $125 billion in capital to their shareholders. So this company returns so much money back to their investors year after year after year. And they do maintain the highest dividend safety score possible, coming in at a 99, and I currently own 27 shares of this company in my own portfolio. It makes up around 3.4% of the entire weight, and you can see I'm actually flat on this position, only up $8 or 0.2%, and they pay me $93 in annual passive income. So Procter & Gamble, the consumer staple representative in this dividend stock video. And now moving on to sector number 8, we have the utilities. So another boring sector worth less than 3% of the overall S&P 500, but I have chosen the brand that I think is actually very strong and many people often overlook, and it is ticker NEE, which is Next Era Energy. They trade for $73 per share and are up by around 20% on the 1-year chart. They are the largest by market cap in the sector, worth around $143 billion, with a dividend yield just above 2%. And why I like this company is because they operate in not only the traditional utility sector, but also in the growing renewable business as well. They own FPL, which is the largest electric utility in the United States. As well, they're a world leader in electricity generated from the wind and the sun. So this business has 2 key operations, one focused on renewables, which I believe to be the future, and I think solar and wind power energy is going to be very proficient within the United States, and Next Era is already a big leader in that sector. Then of course we have the traditional utilities, which provide some stable and growing cash flow year after year, and Next Era is a big player in that as well. I do own this company in my portfolio, and we can see they have a current yield right around 2%, a payout ratio only 61% of their net income, which is actually pretty low for the utility sector and very, very sustainable. And they have a massive 5-year dividend CAGR of over 12%. And this is a dividend aristocrat at a 26-year straight dividend growth streak. And right now, their dividend is coming in at a 99, which is the highest rating possible. There's not many utility companies that have a considered very safe dividend. And to come in all the way at a 99 is very, very impressive. And you can see I put my money where my mouth is, and I own 55 shares of NEE. It makes up around 4% of my portfolio, and I'm up 10% on this position at this current point in time. So another big utility company I think is definitely worth taking a look at for some broad-based exposure into both renewables and their traditional sector. So that was ticker NEE coming from the utility sector. And now moving on into sector number 9, we have materials, and I think this is the sector that most investors avoid. Many investors build up a full dividend portfolio but own no materials companies just because of the nature of those businesses. They're boring, they're pretty complicated, not many people understand them, and they're not very flashy. So many investors completely avoid materials, and I understand why when it only makes up around 2.6% of the entire S&P 500. But the company I chose for this video is ticker APD, which is Air Products and Chemicals, who trades for $292 per share. We can see some share price appreciation of around 26% on the 1-year chart. They have a market cap at $66 billion and a dividend yield of 2%. And we can see right now their payout ratio does seem sustainable, coming in at around 66% of the net income. They have a nice dividend growth streak of 38 consecutive years, so a very strong dividend aristocrat, and a massive 5-year dividend CAGR of over 12%. So if you're a type of investor that wants to touch every sector in the market, you can find a nice material company like APD, a nice average yield of 2%. It's growing phenomenally year after year, and they've proven through good times and bad, they can still grow that dividend as time goes on. And coming in with a 95 and a very safe dividend, not really worried about a cut coming anytime soon from this chemical giant. So overall, that's the representative from the material sector, and let me know down in the comments below if you own any other brands, because I'll be honest with you, I'm sure there's not many people who are heavy investors within this sector of the market. And now we're going to jump into number 10, which is real estate, and of course this makes up all the REITs on the market right now. And instead of going with a traditional REIT like Realty Income ticker O, I chose a specialty REIT for this video, and I'm going with ticker DLR, which is a data center REIT. They trade for $154 per share. They're up by only 7% on the 1-year chart, and the company has a market cap at $45.9 billion with a dividend yield of just below 3%. And currently, they operate 284 facilities in 23 different countries. So they are diversified on a global scale, and I think data centers are a type of platform in a real estate industry that will only grow as more companies go digital and we become a more digitally native society on an international front as well. And we can see total revenue for this company continues to grow year after year to over $4.1 billion in the trailing 12 months, and their dividend that comes in just below 3% is growing at a CAGR at 5.6% per year. Their payout ratio is around 71%, and taking a look, they are coming in with a 94, so it is still considered very safe, and the company does have a very low beta, so not as volatile as the overall market. And if you want some diversified exposure, and even in the real estate sector, you want to get into a specialty REIT that doesn't own shopping malls, apartment buildings, or different complexes or warehouses, DLR is definitely a brand to take a look at. So they're stock number 10, and now if we finally made it to the last sector of the market, the smallest weighting in the S&P 500, and that is energy, making up only 2.33%. It's a sector that gets talked about a lot, even though it's the smallest in terms of weighting within the overall market. And we can see the company I chose is ticker CVX, which is Chevron. They currently trade for $103 per share. They're up by 17% over the trailing 12 months, and I believe this is the strongest oil and gas energy company on the market right now. From their latest investor presentation, they showed the health of their balance sheet relative to their peers, and they are at the top of the list. They have a market cap at $211 billion and a massive dividend yield of 5%. And we can see the company's current yield does make up a large portion of their net income, right around 95%, which of course is very alarming, and I do believe it's too high. But because of all the shutdown of oil throughout 2020, the price is recovering as of late. I think their earnings and their net income will come up over the next few quarters, bringing the pay ratio down to a much more sustainable level. And we can see the 5-year dividend CAGR comes in at 4%. And even though oil turned negative over the past year, the company did not cut their dividend, and they actually raised it throughout the tough time. And they come in with a dividend safety score of 65. So although it is not the highest score like we've seen throughout the video, it is still considered safe. So a big giant to take a look at from the energy sector, which of course is the smallest in terms of market cap within the S&P 500. So that was the last stock we're going to go over today. And to wrap up, we took a look at a dividend paying company from every sector of the market. By no means am I saying these are the only companies you can choose from, and I'm not saying these are actually the number one company from within each. Everyone has their own opinion, and I'm sure many people will argue that a different stock should have been included in this video rather than one that I mentioned. And going forward, I will make a new update version of this video over the longer term with different companies from every sector to give you a greater diversified list of names to take a look at. But overall, these are some strong companies if you want to build out a diversified dividend portfolio to build some growing passive income over the long term. These are definitely some brands to take a look at, and many of them are paying out a dividend that is considered very safe, like we saw from Simply Safe Dividends. So I want to thank you for watching the video to the end. Please hit that like button and subscribe if you already haven't done so. Join the community, leave me a comment down below, and I will see you in tomorrow's video.